Good afternoon, everyone. I'm Stacy Scott, Marketing and Client Relations Coordinator here at Wickham Financial and Insurance Services, and I'm also your host for today's webinar. We host our monthly Lunch and Learn at noon on the last Wednesday of every month, and we're so glad that you're able to join us today. Our topic for today is a very timely one: tax planning strategies for the end of the year. John Dickson from Henssler CPAs and Advisors is here with us, and he's a certified public accountant, a certified valuation analyst, and a certified financial planner. And we are certifiably pleased to have him here joining us for today's call. And he's going to be talking about strategizing your tax plan so that you can prepare for this upcoming tax season. And just as a reminder, you'll see Graham's calendar pop up from time to time during the presentation. If you want to schedule time with him, please click on that calendar when it pops up and select the time and the day that works best for your schedule, and we'll get you an appointment. And with all of that covered, I'm going to turn things over to Graham and John.
Thank you, Stacy. I'll go ahead and start the call, John, and then I'll pass it on to you. First off, I want to thank everyone for being on the call. I hope y'all had a great Thanksgiving. You had time to really enjoy being with friends and family, hopefully a safe one. But it is a timely topic. As Stacy mentioned, we're approaching the end of the year, a very unique year, as they have seemed to be over the last three, right? So it is about tax planning, maybe starting to consider some tax strategies that we want to employ to, I guess, keep more of what you work hard for, right? So when we think about wealth management, if you're a client of ours, if you're new to the call, we like to take a total approach in terms of wealth management. So we're thinking about retirement planning. We're thinking about investment planning, like implementing investments, allocations, so on and so forth, risk management strategies. How do we make sure that we can mitigate risk, pass some of that risk off to some other entities like insurance, health, life, long-term care, auto, home, and your business. Estate planning, paramount. When we teach our multi-day retirement planning classes, we have 8 different chapters we cover in that class, and estate planning, I always say, is one of the most important because you've built a legacy, you have a will and a wish, and you want to be able to pass that on to the ones and things that you care about efficiently. And last but not least, we're going to wrap it up with our 5th major topic of wealth management, and that is tax strategies. How do you keep more of what you worked hard for? Again, we're not here to look to break you in jail with the IRS or anything like that. I think John will confirm that with me. But it is your legal obligation to pay less taxes. I usually say that in class, and it usually sets people back, but it is. It's your legal obligation to pay less taxes. What do we need to do to set you up for that? And I know John and myself have some considerations for you today. So without further ado, John, do you want to go ahead and jump in and give us all your great knowledge?
Sure, great. Thanks. Appreciate it, Graham. And like Graham was saying, I always say, there's nothing wrong with paying your fair share. Of course, what they do with it is a totally different topic, and we could spend hours and days probably discussing that issue. But what is your fair share? And there's a difference between tax preparers and I would say tax advisors. And we look at ourselves as tax advisors working with other professionals such as Graham and trying to help the clients and educate clients to maximize their net worth and minimize their tax liability. So by doing that, there's different things that we look at and reviewing and working with wealth advisors such as Graham and helping clients to maximize that net worth. And there's tax strategies that you might not be able to take advantage of in the following year when you're just doing tax prep, right? So the way we look at it is tax prep should just be putting the numbers on papers from all the planning that occurred the prior year. But if you're not doing planning, then really tax prep is a surprise. You don't really know what the number is going to look like, and it might be disappointing in some cases. But if you're doing the planning up front and doing the communication throughout the year and doing the planning, then you know what they expect in April, and you know what the outcome is, and you have the ability to actually reduce that liability. I can't plan for the prior year in April, so there's no planning. There's not much planning you can do the following year for the prior year. So that's why this is a busy time for us, and looking at clients and doing the year-end planning stuff. So I thought we'd start out and looking at some of the topics for individuals. These are some things that we look at, when this time of year and throughout the year in reality, just to see what some opportunities might come up throughout the year, and especially at year end. So the first one I wanted to mention was capital gains and losses. So there's a couple of things here we look at with capital gains and losses. One is the capital loss harvesting to offset gains. Say you had a sale of a real estate property or some other transaction, cryptocurrency or whatever it might be, or maybe you have losses with cryptocurrencies and now you can recognize gains to take that benefit. We're looking at those capital gains and losses for the year, and we're looking at your current holdings to see if we can minimize your tax liability or maybe diversify, working with Graham to say, okay, we have these excess losses in crypto. Maybe in these outside holdings, maybe we can recognize some gains and diversify your holdings to get into other industries and at this time of year. And so we're taking advantage of those tax losses and also helping your portfolio for future success. Something else we look at, with an aging population, a lot of clients might be moving into assisted living facility. And some of these facilities, the upfront costs are tax deductible. We always talk to clients, look at the different facilities. When you look at the planning, they're telling you the cost of these. Well, most of these facilities now issue a letter at the end of the year that give you documentation to support how much of your costs are tax deductible. So if you're putting up $120,000 for an assisted living facility, maybe 80% of that is tax deductible. Well, now we've got a huge deduction that we can use for planning purposes, whether it's gains and losses, whether it's taking excess gains, whether it's doing a Roth conversion, which we'll talk about in a little bit. But all these things are we can't plan unless we have this information. And so it's the constant communication and working with the other professionals to take advantage of these planning opportunities. Another one might be charitable donations. With the standard deduction increasing, a lot of people might not cap out their itemized deductions to take advantage of it. So one thing we help clients with are bunching your deductions in 1 year so that you might exceed that standard deduction. But another way is setting up a donor advised fund. And this is a great way of getting the tax deduction in the current year, but then having the ability to give the funds to the charity in future years. So especially if you had a large tax event, and from that taxable income, you're going to ultimately give to charities over the next few years, well, then you can give it to them, put it in a donor advised fund now, you get the tax deduction. You don't have control of the investments. There's a third party that controls that, but you do control who you give it to and when. So you can give it over a course of number of years for your charitable donations, and you're getting the deduction in a year when you might really need it. Another planning opportunity for charitable donations is qualified charitable distributions from IRAs. So this is where you can take up to $100,000 a year and give it directly to a charity if you're 70 and a half and older. So that counts towards your RMD, but it doesn't count as taxable income. So you're decreasing your adjusted gross income and thereby allowing more deductions for medical expenses and other things because you're decreasing your AGI. And these are things that we're walking through with clients, explaining. I know this is a lot of information very quickly, but I really wanted to give you guys as much information as possible to get you thinking about it, because again, come January, most of these things is too late. These are things you need to be implementing now and looking at. So with the QCDs, you can actually give it to a charity. You don't get the charitable donation, but you don't pick up the income for that. Another way to maximize your charitable giving is giving appreciated stock. So, if you have a stock that has a $10,000 gain and you sell it, you're going to recognize the gain on that and pay taxes on it. And then if you turn around and give the money to charity, you'll get the $10,000 deduction, right? So if I had a stock with low basis, it's worth $10,000, I sell it, I got to pay the tax, but then I get the deduction for 10. Well, instead, you can give the appreciated stock to the charity. And so now you get the $10,000 deduction for the fair market value of the stock without having to pay the tax on the gain. So again, just another planning opportunity to help minimize the tax and fulfill some of your charitable donations that you feel obligated to do. So, just very quickly, those are a couple of items from HSA and 529 plans. These are these are ways to get some deductions for future benefits. So the HSA is the health savings account. So if you have a high deductible plan, you can deduct up to $3,650 for individuals and $7,300. You know, a lot of times we look at these HSAs as more of a long-term care bucket. So, you know, we're not saying you should go out and take the money out, take distributions for, you know, your current medical expenses, because we see the benefit, the tax savings benefit from long-term growth in those accounts, because it's treated like a Roth IRA. The HSA is never taxable. The growth in the HSA is never taxable if you use it for medical expenses. So there's a lot of power in that account to grow tax-free in investments. So a lot of times we'll say, you're getting the deduction now for these contributions, and you're creating a nest egg for future benefits, for health benefits, for medical expenses. 529 is very similar, but it's for education. So you have a 529 plan that you're contributing to. It has to be a Georgia 529 plan. You're putting in a contribution up. You can put up to $8,000 per individual per year, and you're getting a deduction for that for Georgia purposes. So $8,000 times 2. If you have 2 kids, that's $16,000, and then you're getting the tax deduction. So it's giving you a tax benefit today, and you can pull out up to $10,000 a year for K through 12 education. This is something a lot of clients don't realize, that you know, if you've got a child in K through 12 private school, you might be paying the school directly. Well, if you just open up a 529 plan, you can put $8,000 in, turn around 2 days later, pull that $8,000 out for the tuition, and you're getting an $8,000 deduction for Georgia purposes. So, I mean, and you're not getting the tax-free growth out of it, but at least you're getting the deduction from it just by funneling the money through there. So that's something else that we educate clients on, and things that they can do. Because again, somebody might look at, well, $8,000 times 5.75%, excuse me, that's not a huge benefit, but over the course of a child's life, it adds up. And then you take the power of that tax savings into growth and investment, and it becomes a huge benefit. So, you know, we always say, don't just look at the tax savings today. Think of the tax savings every year and the growth of that tax savings when it's invested in the market.
Hey, John, I have a question. Do they have an income limit on the Georgia 529 plans?
They do not.
Okay.
No.
Yeah.
So, and you can, the 529 plans, you can have one beneficiary, but you can always change the beneficiary. So if you have 2 kids and you don't want the headache of setting up 2 accounts because you only want to do 8,000, you can always just put the money in one account, and then you can always shift the money around. So it's not that you necessarily have to have an account for every beneficiary. I mean, some people like to see the different buckets. I mean, everybody's different, but you have a lot of flexibility with the beneficiary of that. Even though it can never be used anything technically other than education, you can always change the beneficiary to a grandchild or a cousin or whoever. So there's a lot of flexibility with that. So some people get worried, well, what if my kid gets a scholarship and they don't need the money? Well, that's great. I mean, you can use it for grandchildren. I mean, you can always take it out. It's just subject to penalty and taxes, but there's flexibility in changing the beneficiary for that.
One last question, John. Can you have multiple 529 plans in multiple states? Let's say fund to Georgia as well as you might have a Virginia-based plan.
You can have different plans in different states. You can also do rollovers. You don't get the tax deduction for the rollover. So say if you had a Nevada plan and you open up a Georgia plan and you roll the 529 from Nevada into the Georgia plan, so just to simplify things so you don't have multiple accounts, you don't get the tax deduction for the rollover. You only get the tax deduction for the actual contributions. But I mean, it could be a case where you take the distribution. If you have a child in K through 12, you can take a distribution from the Nevada plan that would be eligible for the distribution, and then turn around if you're paying for the private school tuition anyway, right? If I'm already paying the tuition, I'm not taking the distributions out, but I want to kind of shift the buckets around and get a tax deduction for it, then I would suggest, paying the tuition basically out of the Nevada plan and then taking cash and contributing it back to the Georgia plan so you get the Georgia deduction. Instead of just doing the rollover and paying the tuition out of pocket, do the distribution for the tuition and then contribute to the Georgia plan so you get the tax deduction. So those are kind of things. And again, it's constant communication with clients and finding out their facts and circumstances, because everyone's different, right? And I can't tell you a tax return costs $750 because I don't know what your situation is next year. And it's these constant communications we're going through in your life and things that are changing, and being able to consult you on those things and come up with plans to help minimize taxes. Again, it's the difference between just a tax preparer and just taking your numbers and putting them on a form versus the advisor who's advising you on these transactions and things that are going on in life. Because the only thing that's constant is change, right? I mean, things change year in year. We've definitely seen that the past 2 years with COVID, and obviously the tax laws are constantly changing too. So just being up to date on that. Something else that's been popular these past few years with the volatility of the market is Roth conversions. With depressed asset valuations, you can do a conversion and transfer your funds from a traditional IRA to a Roth. So that becomes taxable upon that transaction, but you're shifting money that's going to be taxed at ordinary income when you take distributions to never being taxable based on current law. I always remind clients that Social Security was never supposed to be taxable, and now you can be taxed up to 85% of Social Security. So just because the laws state now that Roth aren't taxable, 2 years from now they could come out and say Roth distributions are taxed at 10%. I mean, but so I just remind clients it's good to have a diversification, not only investments but in your tax buckets. And again, that's where the advisor hat comes on, working with Graham and looking at clients and their overall net worth, just like he went over all these different strategies. And tax strategies is one that we work with and try to maximize net worth by minimizing taxes, which also means maximizing value on after-tax dollars for future. And the Roth conversion is one way of doing that. A lot of clients don't realize that they might be able to convert 401ks. A couple of years ago, it came out to where 401ks can actually offer Roth conversions. So that's something, if your plan doesn't allow, you can always request it. It's not difficult. All they have to do is change the plan. We have clients that have done that before as well. It's just you just amend the plan to allow it, but it allows you to, again, convert dollars. If you're in a business and you had a large loss, one way to maximize that loss deduction is to do a Roth conversion, whether it's through an IRA or 401k. It generates taxable income that you can then use for the losses. So it's just a couple of things there to remember, tax planning and doing the tax projections, again, to see what bracket is the maximum value. If a lot of clients don't necessarily want to jump up into the 32, 34, 37% brackets, but if they can stay in the 22 and 24% bracket, they feel like, that's a good trade-off. Is I'm generating income, I'm being taxed at a relatively low rate, historically, considering historical rates, and then I'm getting into a Roth IRA. So those are analysis we do. And again, we're educating clients and letting them make the decision. So if you convert 100,000, this is your tax impact. You might stay in the 22% bracket. If you convert 150, you're going to jump up into the 24% bracket, and so on. And the thing that we always tell clients, if we knew all the variables, if I knew when you're going to die, if I knew what the stock market was going to do and what your rate of returns are, if I knew what the tax rates were going to be in 5 years, I could tell you the exact amount break-even point would be. But unfortunately, we don't have a crystal ball and we can't tell you all those variables. So therefore, it's more of helping you make an informed decision based on what we know today.
Excellent.
So that's kind of a snapshot, quick summary of kind of the individual things we look at. The next thing I wanted to focus on was some things we look at from a business perspective. Obviously, business owners are also individuals. So when it comes to business owners, we're also looking at everything we talked about from an individual. It's just sometimes now you have another layer of complexity because of the business. And these are things, again, we're advising clients on, throughout the year, so that come following April, everybody knows what the tax liability is. We know what the number is going to look like because we've done the planning, we've done the consulting and the advising, and everybody knows what the impact is going to be. For new clients, first thing we look at is entity selection. We still see a lot of businesses as Schedule Cs, so they're paying self-employment tax on 100% of their profit. A lot of times we'll do an analysis to look at what it would look like if you're an S Corp or looking at making it a partnership. historically speaking, Schedule Cs are more likely to be audited because of the tax impact upon audit. Every dollar the IRS recognizes of either increased income or decrease in deductions is subject to self-employment tax. So that's 15.3% on top of the income tax for that income. So there's just more reward for them to look at Schedule Cs. And a lot of times that's why when they talk about audit rates, you see the individuals with the lower tax brackets being audited more. It's usually because they have a Schedule C, because it's more beneficial for the IRS to audit those because they get more bang for their buck. So that's the first thing we look at, is trying to minimize self-employment taxes by looking at, doing an S election and then planning around that S corp, changing the entity structure. There's some of these other components that we'll talk about that come into play there too. For this year, this is a big one. The next one, the entity tax election for Georgia state taxes. So in the past, people might be familiar with the Georgia Gold credit for education purposes, the Rural Hospital credit for Georgia taxes, so where you're contributing to a Georgia hospital. Those credits in the past allowed you to take a deduction for business and then get a credit for your state taxes. So you're getting a federal benefit. There's great rate of return and great incentive because you're getting a rate of return of your federal rate on that contribution. So if you're in a 34% tax bracket and you do $10,000 to the rural hospital credit, you're getting a $3,400 tax benefit for that. Plus you get the $10,000 credit. So you automatically made 34% on your investment, right? So it's double dipping. So, well, there's been a lot of states now trying to get around this $10,000 limit for Schedule A, and Georgia is just another one of the states this year that is allowing the entity tax election. So for business owners, if you're a flow through, you can elect to have your Georgia taxes paid at the entity, similar to a C corp, so that you can take that deduction for the business. However, this is the first year that you can do it, but the taxes need to be paid based on your accounting method. So if most taxpayers are cash basis, most businesses we work with are cash basis. So that means you have to pay the tax by the end of the year. So again, this time of year, we're working with clients to say, okay, if you want the Georgia deduction cash flow wise, you're going to have to pay it now, versus if you don't want the deduction, you pay it in April with your individual tax return. So going through that analysis with clients and letting them see from a cash flow perspective, what's the lost deduction versus time value of money, right? So you're getting to hold on to your money for a couple more months versus getting the tax deduction. So you're trying to, illustrate that for clients and let them make that decision. A big one for small businesses, and we work with Graham a lot on this, is retirement planning. Establishing 401ks by the end of the year is something that has to be done by the end of the year in order to take advantage of it in the following year. SEPs you can always set up the following year, but something that needs to be done by the end of the year is 401ks. And solo 401ks are pretty easy to set up, pretty cost effective to administer. So a lot of our single business owners are using these. They don't have, they might be the only employee, so the cost of them aren't as high as a planned 401k. But this is where you're taking money out of your left pocket, you're putting it in your right pocket, and you're getting a tax deduction. I mean, it's a beautiful thing from a tax perspective. Most tax deductions, you're spending $1 to save 40 cents, right? So wouldn't you rather have the 60 cents than spend the 40 cents just to get a tax deduction? I hope the answer is yes. But in this situation, you're taking it out of your left, putting it in your right, it's still your money, and you're getting a tax deduction. So we work with clients and trying to look and see, and a lot of times it comes down to cash flow. With a small business owner, with a solo 401k, you have more flexibility in funding these. So you actually have, you can fund it through the following year, whether it's your deferral or your profit sharing match. So you've got some time for cash flow to fund it, and take the deduction, but you have to have it established by year end. So that's something that we're always working with clients. And because a component of that is compensation. So as I mentioned with the S election, with an S corp, the business owner has to have a reasonable comp, and that's a totally different discussion. But from that reasonable comp allows you to do the 401k contributions from a profit sharing and the deferral. So we're always looking at that to see, okay, from a cash flow, how much do you want to maximize your 401k contributions? Or do you just want to do the deferral? Do you want to do a deferral and a profit sharing match? So walking through that calculation and letting them know this is the tax impact from a self-employment tax or from a payroll tax standpoint, because as an employee, they're not paying self-employment tax. Now it's payroll taxes. So this is your tax impact from a payroll tax. This is what your potential benefit is from the 401k contribution and deduction. So walking through that analysis with clients. And again, it's being creative and having this communication and open line of communication with clients and taxpayers, and coming up with these strategies so that they can make an informed decision, and it's not coming down till April 15th and they're getting shocked by what they owe. Another very quickly creative way of decreasing tax liability is just shifting income. You might have family members or kids that you can put on the payroll and pay. And then they could be able to contribute to the IRA. If you've got a plan 401k already established, you might have them participating in a 401k, and being able to shift income from your high tax bracket to their low tax bracket, plus being able to save for retirement. I personally like Roth IRAs for kids more than 529 plans, just because they can use it for education as well as retirement if they don't need it. Some people do both. But I really like the Roth IRAs from that standpoint as well. So we have a lot of business owners that do that. And then just a quick reminder, I reviewed a tax return prepared by another preparer just the other day, and for 2021, they only took 50% of their meals and entertainment expense. Meals expenses. Meals are 100% deductible for 21 and 22. As part of the COVID relief, they're trying to incentivize people to go to restaurants. That includes fast food restaurants. It has to have a place with a kitchen and a seating area. But you can order it to go. I mean, you don't have to stay there and eat. I mean, for the majority, unless you're going to the Publix deli and picking up lunch, the meals are 100% deductible. So that's something I just wanted to remind people. And from a record keeping standpoint, if audited, you want to have good records. Coming up, most people will lose deductions because they're not keeping good records. So have the separate credit card, have the separate bank accounts, because don't make it a habit of paying business expenses from your personal accounts just because you'll forget. I mean, I see it all the time. Again, one of the best tax saving secrets is good record keeping to keep track of all your deductions.
No, that's great. John, as we kind of move, and thank you so much. That was incredible information in a really short amount of time, I know. But I want to take some liberty here and ask you, are there some additional considerations our high net worth clients should be thinking about? And I know many of them might have businesses, many of them, maybe they don't, because we're seeing the largest transfer of wealth ever in history now and going forward with the baby boomers. So what are your thoughts on that, additional considerations?
Well, we've seen a couple this year go beyond for your typical 401k plans and introduce cash balance plans and defined benefit plans. I mean, we've had some clients go beyond just the 401k. Again, you're getting the tax deduction now for future benefits. We have I think with the debt that we've seen, we have a lot of more clients doing a lot of conversions just to get, they feel like tax rates are going to go up. And the high net worth is where the tax rates are going to go up the highest, right? So, I mean, somebody in the 35% might think 35 is high, but it could be 60 or higher. I mean, we just don't know, but we are seeing people utilize what's historically low tax rates now, speeding up the income and getting it into more Roths accounts. I mean, you'll see in the news the IRS has been talking about cracking down on Roths because the amount of value that people have transitioned into the Roth accounts over the last few years, the high net worth individuals. They talked about limiting it. I don't know that they'd be able to do that, but I think they've proposed it a couple of times, whether that's 5 million or 10 million or whatever the number might be. But we're seeing a lot of that. It just depends on, there's some people will do different charitable remainder trusts and things from a state standpoint, setting up trusts just to transfer. I mean, as the values are, if we do see the values drop again, there's people that take advantage of using their gifting and transferring into trust to get the low value out of their estate. So we're looking at an estate, looking at some of the other things, because some of your other topics you mentioned that you focus on, like estate planning, I mean, a lot of that has tax implications. So working with the professionals and the client to come up with the best strategy, because it really depends on what's your overall end game. Is it to sell the business? Is it to give it to the kids? Is your estate plan to give it to charity? And looking to develop planning strategies along with the estate and tax to minimize that impact. So,
okay, super, thank you, Stacy. I think we may have time for maybe one or two more questions. I know it's a great topic today.
Yes, and I did get a couple of questions in. So first of all, when it comes to capital losses, how does the wash sale rule work?
Good question. Some people aren't aware of this, but the IRS will limit your loss associated with transactions that occur similar in nature. So if you're planning to sell a stock for a loss, you can't acquire it or you can't reacquire it 30 days before or 30 days after, or they'll limit your loss. So if they don't want you to turn around and buy the same position back. So if you sell a stock for a loss, you can't buy it back for 30 days. So that's that is reported to the IRS by the broker. So that's being tracked.
And I think there's considerations in an index fund, an ETF that has a high exposure in that name, maybe a like company in its peer group. There's certainly ways around.
There is, yes. It's just the same or a similar stock. So a lot of times that's how people get around it. They'll buy an ETF or the index fund or something that's highly weighted in that stock, which wouldn't be subject to the wash sale rule. So
yeah, excellent.
Okay, how about do we think the market is going to pull back by the end of the year because of tax loss selling?
John? I'm assuming this one's coming to me. So, we'll just have to see. I mean, the market, we got a good tailwind right now, as we said in our previous calls. Santa Claus rally, window dressing, this time of the year tends to be very good. You do have losses. Maybe people want to take those losses to offset some gains. We've had some real sectors, highly owned tech, the mega cap techs, Googles, Apples, Microsofts, they're all down, Meta. So, I wouldn't be surprised to continue to see some high volatility as we approach the end of the year, even though it is a very good positive time for this market to continue to move up, that we might have periods of sell-offs as we move late into December for tax loss selling. Also, we've moved up pretty good, 10, 15% in a very short amount of time. Did we buy a little bit of that future rally now, meaning it moved forward a little bit? Possibly,
Okay. Well, thank you so much, guys. This was really great information to hear as we inch our way closer to the end of the year. And thanks to all of our viewers for joining us and getting those questions in for us. Remember that you can get current market updates from Graham every week on our weekly wrap-up. So please tune into those to get the latest and greatest information on what's going on in the market. And also, as we head into the holiday season, our staff is collecting food items to deliver to the Center for Family Resources. And we're inviting you to drop off donations at our office anytime over the next couple of weeks. We have a list of items that are especially needed on our website and on our social media. So please check that out. And of course, give us a call if you have any questions. And together we can help hungry families in our community this holiday season. Also, we have Graham had the opportunity to be a contributing author for this book, Retirement Strategies for the New Economy. And we do have some copies of this book available at our office. So if you're interested in obtaining one of these copies, give us a call and we'll make sure to set one aside for you. Thanks again for joining us today, and we hope you have a great afternoon. Thanks so much.
Thank you, John. Thank you all.
Thank you. Appreciate it.